Hi, everyone. I'm David Silver, CEO of Instrumental Wealth. Joining me today is Matt Harbert, Chief Investment Officer at Instrumental Wealth, and Drew Allen, Senior Wealth Advisor at Instrumental Wealth. And we're really excited today to have Matt join us and talk through the 2023 recap of everything that took place in the economy, the markets, and some of the changes that we've made in your client portfolio. So, Matt, why don't you go ahead and jump into things? I know our clients love hearing from you and talk through all the things that took place in the economy in 2023.
Sure. So in 2023, there actually were several events that took place in the U.S. economy. I'll talk about a few of them. First, earlier in the year, we did have the crisis in the banking system. So in March, Silicon Valley Bank collapsed. And then 2 days later, we had another failure of Signature Bank. This actually sent a wave of fear that there'd be contagion leading to another financial crisis. And then out in May, we also had First Republic Bank that struggled and got rescued by JP Morgan. Because of this fear, the Fed stepped in. So the Fed decided to take some steps to try to reduce or eliminate the contagion in the financial system. And they took two steps. The first one was that they guaranteed that all depositors would be made whole and would have access to all their funds immediately. Secondly, they created a funding program for the banks so they'd be able to meet any depositor needs if they had them. Really, the idea was to just provide liquidity in the banking system and guarantees so we would not have more bank failures. So the question was, did they succeed? And it does appear that those steps did succeed as we started to see stability gradually make its way back into the system. The final bank to fail was in July. That led to a total of 4 bank failures in 2023. And if we had any significant contagion, we would have likely had quite a few more banks than just 4 fail at that time. You can also see this by looking at the markets. This chart shows the purple line is the banking sector in the S&P 500, and the orange line is the regional banks. You can see the initial sell-off after the collapse of Silicon Valley and Signature in March. But once the Fed stepped in, you can see it really kind of flatlined, a little bit of volatility to some extent, but for the most part was mostly flat through the year. And then in October, we actually had a rally in that banking sector. So, looking at those, it does appear that, we kind of got through that and the Fed's steps did succeed in preventing that contagion any further. Another thing that occurred last year was a downgrade to the U.S. credit. In May last year, the rating agency Fitch put the U.S. credit watch on downgrade. And then in August, they officially downgraded the credit from AAA to AA+. They primarily gave the reasons that we had the rising national debt and the political dysfunction in Washington. This was actually only the second time in history we've ever had our credit downgraded. The first time was back in 2011. Standard & Poor's downgraded U.S. credit. Fortunately, the markets largely shrugged off this, and the only real impact from this was really just to the U.S.'s reputation. The big news in 2023 really was the Fed's continued battle with inflation. Kind of to go over what led up to this, in 2021, inflation started surging as the economy was opening up post-quarantine. In 2022, the Fed realized they had sort of missed the boat on that, and so they had their first rate hike in March. They realized they had to take a extremely tight policy, which this ended up resulting in the fastest and strongest rate hike cycle in history. To give you some idea of where inflation was at the time when they did their first rate hike, inflation was just under 8% when you looked at the CPI. We actually hit the peak inflation that year in June of just a little bit over 9%. So that leads into 2023, and what we were looking at as that battle of inflation with the Fed continued. The inflation trend continued downward. So as we started into 2023, the CPI was 7.04%, and that got down to 3.35% by the end of the year. We also saw the Fed complete their tightening cycle. So their final rate hike of 25 basis points was in July. That capped off a total rate hike through the whole cycle of 525 basis points. And as I mentioned earlier, this was the fastest rate hike cycle that we've had. And then surprisingly, in December, Powell hinted at rate cuts beginning in 2024. This was a surprise because they sort of were really telling everybody that they were expecting to keep rates higher for longer. Their estimates that they had produced were reflecting that, and that was kind of what people were expecting. So when he came out in December and hinted that there might be some rate cuts in 2024, that was a nice surprise.
Yeah, Matt, thanks for that overview. Great overview and talking points there. Talk a little bit to our clients about how the markets ended in 2023.
Sure. So how did the markets do in 2023? So looking at the equity markets, it was a fairly volatile year. When we were looking at markets in November, they were actually well off the peaks that they had for the year. They, depending on the market we were looking at, they were anywhere between 10 and 20% off their peaks. However, in December, likely related to Powell having, his comments over interest rate cuts, we had a nice strong rally, which led to overall for 2023, the markets had a decent year. If you look at U.S. markets, they were just under 26%. The international developed markets were over 18%, and the emerging markets were just under 10%. If we look at the U.S. markets, they were strong across all the market caps as well, with large caps over 26%, and then both mid and small caps over 16%. Now, one thing to note, while the U.S. market, the large cap markets were very strong, that might be a little bit overstated with the 26.29%. Much of that was actually driven by just 7 stocks, known as the Magnificent Seven, which comprise of Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. So when we look at just those 7 stocks, they were up 75% for the year. And so when we pull those 7 out of the S&P 500, the remaining 493 were only at 10.39% for the year. Still a decent return, but much more in line with the other equity markets that we've seen, and certainly shows that the breadth of the market was fairly narrow. Next is the bond market. So the bond market, sort of a similar story, with the Fed raising rates through the first half of the year, and then kind of that narrative of higher for longer with interest rates. Both of those put pretty significant downward pressure on bond prices. And if you look at October or November on the chart, you can see that the market was actually negative at that time. But then with Powell coming out with kind of those dovish comments, we had a nice rally in December, and the market ended up with a pretty strong 5.5% return for the year overall.
Yeah, excellent. So we made a lot of changes to the portfolio last year. Can you talk a little bit about that?
Sure. So yes, we did make quite a few changes over the year. One of the big changes that we made is adding alternatives to the portfolio. So we really added two categories of alternatives. The first is growth alternatives with private equities, and the other was income alternatives with private credit and income-oriented private real estate. Private markets was something we really wanted to try to add exposure to the portfolio. Historically, these markets were only available to institutional investors. But recently, there's been some changes with how the market works structurally and some investment vehicles that did allow us to get access for individual investors. So these markets are not just for institutional investors anymore. A couple of those changes made is first, interval funds. So interval funds is an investment vehicle that really works out well for private funds. It allows managers to offer these with much smaller minimums that we've seen in the past. They also typically have an evergreen structure. And really what that means is with traditional private funds, they're finite. So after a period of time, they shut the fund down, they close it, they sell their investments, and you get your funds back. Evergreen funds are intended to be managed in perpetuity, so you don't have to worry about them closing down. But the biggest benefit to the interval funds is adding some liquidity, where traditionally you have no liquidity in private funds. They lock them up for 8 or 10 years, and your funds are stuck there for that period of time, and you have to wait until the managers unwind that fund and start paying you your funds back. With interval funds, they typically offer a window to get some of those funds to make redemptions quarterly. So there are some restrictions. It's not perfect liquidity, but there is access for individuals to get some of those funds if they need to on a quarterly basis. Secondly, there's been a growth in what's called the secondary markets for alternatives. That allows managers to essentially go out there and purchase other private funds or sell some assets they have. So it actually provides some liquidity for the manager. It also allows them to add diversification, which is important when you're looking at mutual funds and smaller investors. You can get that diversification, which with smaller investments, instead of needing those large commitments to try to get that. Before we go there, one thing to note, private markets are becoming a much larger portion of the investable universe. It's making them a much more important asset to have to invest in. And part of that is due to what we just talked about here. So with the changes in providing more access to individual investors, becoming a higher demand for that. But we're also seeing that companies are staying private longer. If you look at the two charts on here, one thing you'll note on the top left chart is companies are going IPO much larger in size than they did in the past. So going back to 1999, kind of the median size company that decided to go with IPO was a 493 million in size. But going up to 2022, companies are staying private till they're much larger in size, and the median size to go public is almost 2.4 billion in size. So definitely waiting till they're a much larger company before they decide to go public. If you look at the right chart, it also gives kind of a timeline there. So this is looking at some big tech companies that you'd be familiar with, but back in the 80s to 90s, you can see Apple, Adobe, Cisco, Amazon. They basically, from founding to IPO, you're looking at 3 to 4, 5 or 6 years before they decided to go public. Going forward, you can see that timeline has stretched as we've moved, and looking more recently from, say, 2015, that timeline is stretched for many of these companies to 10 to 20 years. So they are staying private longer. And why is this? So first is the demand for private investments is surging, which is providing a lot more access to capital for these companies on the private side. So there's less need for them to go to the public markets to get capital. This allows them, if they stay private, to avoid a lot of the stringent requirements put on by the SEC. So it gives them a lot less headaches when they stay private. And finally, frankly, they don't have to worry about the fickleness of the public markets. So they can really concentrate and spend their time focusing on their business and not on the performance of their stock. Looking at this chart, you can see just over the past decade, the number of companies over $1 billion in size that are private have dramatically increased. And this is a trend that we do expect to continue. In addition to private equity, companies are also increasingly turning to the private markets for loans. The traditional ways to borrow money for companies have been through bank loans or floating bonds. And there's been some challenges there. The banks have become much tighter in their lending standards, and particularly given what happened with the banks last year, the crisis that we just talked about earlier, that's become even more of an issue. And then floating bonds, it's heavily regulated. It takes a lot of time to go through that process. It also has a fair amount of fees to deal with the regulations and pay out all the syndicates and everything else. So it is a costly and time-consuming method to borrow money. However, if they go the private route, they can complete a loan in just a few weeks. They don't have to worry about any of the legal headaches when they go that route. On top of that, there's a lot fewer costs. They don't have to worry about the costs of dealing with the regulations and everything else. In addition, there's also benefits to the lenders as well. You get higher spreads on these loans, which businesses are frankly willing to pay, because if they can get a loan done in a few weeks, avoid the costs and the regulations, they're willing to pay the extra interest on top of that to go that route. On top of that, the covenants that the private lenders are able to put in are a lot more beneficial to the lenders, which provides better protection for the investors as well. So I can talk a little bit about the portfolio as well. We did make some changes in the tactical side of the portfolio. Some overweights that we put on in the portfolio was US large cap, private credit, and fixed income. We also put some underweights in there: international developed, emerging markets, and real assets. We also made several changes of our fund lineup. So some things that we added to the portfolio, the PACER funds. These are a higher quality fund we wanted to get with some concern over possible recessions, volatility of the markets. We wanted to get some higher quality funds in there. So the PACER funds we wanted to put in, and we put their funds in large cap, US large cap, US small caps, and international developed. We also, given what we just talked about, added the private equity interval funds. And then we also added the interval funds for private credit and private real estate. The last thing that we added actually a theme to our thematic bucket: transitional energy, with the iShares Global Clean Energy and the Wilder Hill Clean Energy funds. Then we also removed some funds out of our portfolio through the year as well. In our liquid alternatives, we removed the long short equity. We got rid of a theme as well. We got rid of the leisure and entertainment theme that we had. This was kind of a leftover theme that we had from the opening up of the economy out of COVID. So we ended that theme. And finally, in fixed income, we eliminated the PIMCO real return. So what worked and what didn't work, frankly, of those decisions that we made in 2023? So some of the things that did benefit the portfolio on the allocation side was our overweights to U.S. large cap and private credit, and our underweights to international equities. On the fund side, the additions of the PACER funds and the alternative credit funds were positive. And the removal of the long short and the travel and leisure were positive. And what didn't work in 2023? On the tactical side, our overweight to fixed income did not work. While fixed income did actually have a good year for fixed income, they still underperformed the equity markets. So it wasn't as beneficial to the portfolio having that overweight. And the addition of private equity. So private equity did struggle in 2023. However, given much of what we just talked about in the private equity markets, we do still really like the private equity markets in the longer term. We do think it's going to be a strong area for the portfolio going forward. And then the addition of the transitional energy theme, another area that did struggle. Clean energy had a very difficult year in 2023. But again, this is a long-term addition to the portfolio. We like this theme, particularly given the push of governments all over the world to move into clean energy, to reduce our reliance on fossil fuels. There are regulations in place requiring these things to happen. So we do think in the long term, this is going to be a good benefit to the portfolio.
Great. Maybe talk to our clients that are watching this about 2024 and what we're expecting, what we're looking for.
Sure. So, we can't predict what's going to happen going forward. But some things we do think are likely to happen. First is inflation. We do think inflation is going to continue its downward trend through 24. And the Fed cutting rates. We do think the Fed is going to start their rate cuts in 2024. Now, we are not in the camp that many have been predicting of 6, 7, 8 rate cuts over the year. We kind of look at there's probably going to be 1 or 2 scenarios that could happen through the year. One is if we end up with our soft landing, the economy stays healthy, it's likely to be more like 2 or 3 rate cuts, probably starting maybe mid to later next year. The other scenario is exactly the opposite. If we do hit a recession next year, then it's likely that we'll have 1 big cut by the Fed, possibly even bringing it closer to that 0 inflation rate that we've seen for so long. Now, the probability of a recession happening, we do think there's probably a higher probability that we'll have a soft landing next year. Now, that being said, we don't think we're necessarily out of the woods right now of having a recession, particularly when we look at certain indicators. The yield curve is still flat. It's inverted. It inverted back about mid last year, which is hinting at a recession, which would put it, given the time that when it starts to invert, that we start to see a recession, is usually about 18 months, 24 months, somewhere around there. So that would put us sometime in the middle of next year. So that indicator is still flashing red. And then if you look at the leading economic indicators, it's still in that sort of recession zone. So while we think the probability is higher of a soft landing, there's still, several things out there that we certainly wouldn't take a recession off the table, particularly a mild one. With interest rates likely to be cut next year, we do think that's going to benefit U.S. equities. So large cap should continue to remain strong, and we expect that strength to broaden out a little bit beyond that Magnificent Seven group. Also, we could see even more benefit to smaller companies since they're more sensitive to interest rates out there. And then finally, with the interest rates cut, we should also see benefits in U.S. fixed income as well.
Well, Matt, we certainly know that no one has a crystal ball, but thank you for giving that oversight for 2024 and some of the things that we're expecting this year. And again, big thanks to you and your team for putting this together for our clients. I know they always find it extremely beneficial when they're able to have some time with you, even if it is on a recording like this. So for everyone watching this, if you have additional questions for Matt or Drew or myself, don't hesitate to reach out to us, shoot us an email, message us on social media, whatever is easier for you. We're here to serve. And thank you again for this insight, Matt. Again, I know our clients find it extremely helpful. Thanks for putting this together for everyone. Have a great day, everyone.